Today we shall see what is cash flow statement. Actually, while preparing the financial statements, the purpose of income statement is to prepare the operating results. And then the purpose of the balance sheet is to find out the financial position of the company. The third important stage is cash flow statement. So what is cash flow statement? Actually, it provides inflow and outflow the cash and cash equivalents during a particular period of time. It is nothing but the historical changes in cash and cash equivalent during a particular period of time. Formally, accounting standard as per Institute of Chartered Accountants of India (ICAI) deals with the changes in financial statements. That means fund flow statement. Now it has been revised and deals with the cash flow statement. The main purpose and objectives of cash flow statement is to collect information about how much cash coming inside and going outside in respect of three activities. The first activities is operating activities, and then investing activities, and then financing activities. Let's see cash flow from operating activities. There are both cash inflow and outflow. Under what circumstances cash inflow? For example, if we make a sale, we will receive cash. If we render a service, we will receive cash. So cash is coming inside. So the receipts, cash receipts from sale of goods and services and rendering services. And the next one is cash receipts from fees, if there is any fees or commission or any other income. So cash is coming inside. These two are cash inflows from operating activities. Apart from that, there may be cash outflows. For example, if we pay to the supplier, creditors, if we make a purchase, we have to pay. So cash payments to suppliers. And then cash payment to employees, if we pay wages, salaries and bonus, etc. like that. And then cash payment to insurance company, if we take a policy, we have to pay premium every year or every month. And then if there is any annuity and any benefits, we have to pay something. And then cash payments of income tax. For the year, for the past year, if we have to pay cash payment of income tax, it will be entered in the operating activities. But there is an important point, we have to note it down, that it can be explained. Payment to income tax can be explained both financing activities and investing activities. So unless they can be explained with financing and investing activities, we will take into this account, under the operating activities. The next important one is cash flow from investing activities. How much cash we are getting inside into the business under investing activities. For example, if we receive cash from the disposal of any assets, if we sell our plant and machinery or fixed asset or car or building, anything, we will receive cash. So cash receipts from the disposal of fixed assets, and then cash receipts from the repayment of loan. For example, we had already given a loan to third party. So they will repay that amount. While they are repaying, we are receiving. So cash receipt from the repayment of loan made to the third parties. We have given the loan. And the third one is cash receipt from the disposal of shares. For example, if we sell a shares, warrants, and then debt, any debt instruments, if we sell, we will receive cash. And then interest received in cash from loans and advances. Already, if we have given loan already, the interest on which we will receive now. So interest received in cash from loans and advances. And then if there is any dividend, for example, if we have invested in others company's share capital, we will receive periodically some dividends. So dividends received from investments in other enterprises. See, these are the main important instances of cash inflows into our business. Cash outflow from investing activities. If we purchase any machinery, any building, any other asset, for example, computer, we have to pay cash. So any payments towards acquirement of fixed assets, and then cash payments to acquire shares, warrants, debt instruments, the cash is going outside. And then if we provide any loans and advances to the third parties, cash is going outside. These are the three important cases under which the cash is going out, that is cash outflows under investing activities. The third stage is cash flow from financing activity. How much cash coming inside, into the business from financing activities, cash inflows. For example, if we increase, if we issue share capital to the public, we will receive cash towards that cash issue, share issue. Cash receipt from issuing share capital, both equity share capital and preference share capital. For example, if the share capital were rupees 5 crores, if we issue again 5 crores, the 5 crores amount will be coming into the business. And then cash receipt from issuing debentures. Debenture is nothing but the debt instrument. It is nothing but a loan from the debenture holders. The company is getting loan from debenture holders by issuing debenture certificate. So cash receipt from issuing debentures, and then any bonds, and then any short-term borrowings, it will be the receipt of cash. So these are the cash inflows. Cash outflows will be if we repay any loans and advances. The money already borrowed, if we repay that cash payment of amount borrowed, that is cash is going outside. And then if we have to pay any interest on debenture and the long-term loans and advances, these will be cash outflow. And then if there is any dividend paid on equity and preference share capital, that is a payment. For as far as the company is concerned, it is a payment, so it is cash outflow. If we deduct that cash outflow from the cash inflow, we will get the net flow. We will take into the consideration only the net flow. The general format of cash flow statement is, first of all, we have to find out the net cash flow from operating activities, investing activities, financing activities, and then we have to add all the three. So A, cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. If we add all the three, we will get net increase. How much cash increase during a particular period? So we have to add A plus B plus C, all the three. And then the opening balance is given in the balance sheet itself. So cash and cash equivalent at the beginning, how much? If we add with these three, we will get the closing cash and cash equivalent at the end. Treatment of some peculiar items. Peculiar item means it is nothing but an extraordinary items. Extraordinary item means it is not regular phenomena. It is not happening regularly. Sometimes, for example, it is non-recurring in nature. What will be the example? For example, if there is any loss due to theft or earthquake or flood, these must be classified and disclosed in case of, while preparing cash flow statement. Please make note of it. And then interest received and dividend. First of all, we should see the nature of the institution, whether it is a financial institution or if it is a non-financial institution. Financial institution means what? Financial institution accepting deposit and providing loan. So the nature of business is providing loan and accepting deposit. In that case, if any interest paid or received or dividend received will be classified under operating activities. And then in case of non-financial activities, institutions, interest paid or dividend are classified under investing activities. This is a main important point, we have to make note of it. The next one is taxes on incomes and gains. For example, cash flow from tax on income should be separately disclosed and classified from operating activities. We can, classified under operating activities unless they can be separately, specifically identified with the financing and investing activities. For example, tax on operating profit, it will be classified as operating cash flow. Dividend tax, it will be classified under financing activity. Capital gain tax, it will be classified under investing activity. And then one more important thing, the non-cash transaction. For example, normally we are purchasing any building or any fixed assets by giving cash. In that case, for example, if assets are acquired by the issue of shares but not paying cash but by issue of shares, that consideration is settled by issue of share capital. At that case, it should not be disclosed in cash flow statement.